I'd like to thank everybody for joining me today. Today, I want to talk about helping our business owner clients retain their key employees using split dollar plans. As we look at today's business market and the employee market, it's hard for our good employees to stay put. They get offers to move other directions, and the employment market has become more global, so that you can work in one state and live in another if you want. So, with our business owners, as they're recruiting and retaining their key employees, they need to think outside the box and look at other non-qualified plans that may be attractive to these individuals to help them stay with your business. If you think about this, would you consider a meaningful benefit to employees that would also allow you to recover the costs later? And most of the time with our business owners, we don't have an unlimited amount of resources. So we have to allocate them, or help our business owner clients allocate them, the best way possible to continue to grow their business. And part of that is retaining their human capital. So when we look at split dollar loans, split dollar plans are, setting it up as a loan, it allows the employee to own the life insurance policy. But the premium is going to be paid by the employer, treated as a loan with interest. The interest rate has to be at least the minimum applicable federal rate that's set up by the IRS each month. The repayment of the loan is secured by a collateral assignment. Think about that as a lien against the policy, so that the employee can't do anything with that policy until the employer is made whole. So it's like having your mortgage on your house. You can't sell your home without repaying that mortgage. Same thing is going to happen here with the collateral assignment. What I like here is there's no income tax or deduction to worry about. So the employee doesn't have to worry about, the income tax side of this. The employer doesn't have to worry, is it deductible? So let's look at how this sets up. So the employer is going to pay the premium to the insurance company on behalf of the employee. The policy is going to be issued and owned by the key employee. So they become the owner. They can set up the beneficiary and have that much control over the policy to start with. The employer is going to treat all the premiums as a loan. And at some point in the future, that loan has to be repaid. It can be, if the employee leaves, they have to repay the loan immediately, or there can be a repayment schedule set out for 10, 15, 20 years down the road, whatever the employer wants to do. So the best thing, let's look at a case study. So for this case study, the employer wants to set up a split dollar plan as a loan for their key employee. Premiums are going to be $25,000 a year, and they're going to pay premiums for 10 years. When we look at these plans, I like to look at it from both perspectives, because this has to be a win-win scenario. It has to be a win for the employer, has to be a win for the employee. If we're saying this is an incentive-based plan, let's make sure there's an appropriate incentive there for our employee, so that they can look at this as a positive, not as a negative. When we look at this, we'll look at it how it affects the employer. We're going to look at it how it affects the employee. So there again, taking both sides of the plan and make sure it fits. We said for this plan, we're going to be paying in $25,000 a year for 10 years. That's the commitment that the employer is going to make. As long as you stay for those 10 years, there will be $250,000 of total premium put into the policy. That premium, remember, this is coming from the employer as a loan. That's their gross out of pocket. And if I look at it, there has to be that repayment. Think about that collateral assignment, or that lien against the policy. The first part of that lien is going to be the cash surrender value. So during the loan period, that cash surrender value is owed back to the employer. Now, if you look at this, starting in year one, the employer pays $25,000. There's only $5,552 of collateral. But as soon as we get out to year 10, Now at year 10, if you'll see, there's a round number of 250,000 of cash surrender value. At that point, our employer has paid 250,000. So their loan, their collateral, their lien is now capped at the amount owed back to them. So if anything were to happen, they can be made whole from the cash surrender value. The death benefit is also part of the lien. So the death benefit, starting, if you look at this, that death benefit amount each year is increasing with the amount of premium that the employer's putting in. So 25,000 gets paid in first year, 25,000 of that death benefit gets repaid to the employer first before anything goes to the employee's beneficiaries. So if the employee were to die in year one, the employer gets repaid their out of pocket and they're made whole. If the employee were to die in year 10, there again, the employer's paid out 250,000, employer's made whole out of the death benefit. So if you look at this, the employer at this point is, putting this in place. If something goes wrong, whether the employee wants to leave, whether the employee passes away, employer's made whole. Now let's look at this from the employee's side. What is their net out of pocket? Remember, this is a performing loan. This loan, so if you look at year one, they owe interest of $220. Over a 10-year period, in this case, based off of the applicable federal rate when this illustration was made, the total loan payment over a 10-year period is $12,100. That's the total out of pocket for the 10 years. If we're setting up our repayment in year 15, the employee will continue to pay interest until that loan is paid off. And so that loan will, each year, employee writes a check, pays off the loan or pays the loan interest. That's all taken care of. Now, if we move forward and look at there again for the employee, what access do they have to cash value? Now, if you look in the first 9 years, that's a zero for the employee. The employee cannot touch any cash value for the first 9 years because that is all owed back to the employer until the employer is capped at the point that they're made whole. So starting in year 10, we show $1,534 in the employee's side of the ledger of the cash surrender value, and that amount just keeps growing. Now, if we look at the policy death benefit, I like this. I like how this comes across to when most employees understand this. Now, my employer is concerned that my family's taken care of. If you're a key employee, you're being compensated probably fairly, for the jobs that you do. You're treated as a key member of this company. But now you take the step as the employer and tell the employee, I want to make sure if something happens, your family is taken care of. And just brings in more people to help make sure that the key employee stays with the company. This net death benefit, there again, during the time that there's an amount owed to the employer, that net death benefit is going to be the amount first goes to pay off the employer, the rest goes to the family. Now, if we look at this, at some point we have to show that we're going to pay off this loan. And it's actually, for this illustration, we just show it in year 15. Employer gets paid back their $250,000 of principal. That's going to come out of the cash surrender value. And if you look at the employee, they still have a great policy. And let's look at year 20. Year 20, they've paid a total of $20,900 out of pocket. And that was the interest cost for those years. They have $95,434 of net cash surrender value that they can access tax-free. And if they pass away, they're going to have $906,000 that will pay to their family. So you look at this, is it a win-win for the employer? Is it a win-win for the employee? And I think the answer is yes, because we've incentivized the employee to stay, we've provided additional compensation, and overall, everybody can win. So I appreciate everybody getting on. If you have questions, feel free to reach out and we'll talk again next week. Thank you.